Thank you everyone again for joining us for another Thoughtful Tuesday conversation. We're going to focus on endowment giving, but a whole lot more. My name is Dr. Felicia Blow. I serve as Associate Vice President for Development here at Hampton University. And I'm delighted to be before you tonight as we discuss the topic of venture capital. Our goal tonight is to enlighten, to inspire, and to motivate greater engagement with your HBCUs in the area of endowment giving, and simply really just to get involved. We will bring clarity and focus to the topic of venture capital by reviewing what it is, how HBCUs and their endowment funds may benefit. And the most important thing you all tuned in for tonight is this powerhouse panel. They are going to provide information and enhance awareness to the nth degree. I serve as the endowment fundraising lead here at Hampton. So this is my own little personal commercial. I'd so love to speak with you if you're interested in hearing more about what we do. I'll place my email in the chat and we will go from there. But on with the show, as they say. Tonight, it gives me great honor to introduce one of our moderators. He is not from the real HU, Hampton University. He's from that other HU. He's a Howard alum, but he's a fantastic gentleman. Keon Holmes, Managing Director with Cambridge Associates Boston office. Keon works with Hampton University, as well as a number of other universities, foundations, hospitals, cultural institutions, independent schools, and private clients ranging in size from $50 million to over $9 billion with a B. Keon specializes in constructing and overseeing portfolios for his clients. And prior to joining Cambridge, Keon worked in equity risk management products with UBS, and he holds an MBA from Harvard Business School, and a BS in electrical engineering, which I think is pretty cool, from Howard University. So Keon, thank you so much for being one of our moderators tonight and for being part of this family discussion. And just one quick commercial. If you are not a panelist, I'm gonna ask you to use the attendee link that is in the chat box, and I'm going to type it over, copy it in the chat box for you right now, because this space is reserved for the panelists, and we want to have a thoughtful and easily flowing conversation. So thank you. So Keon.
Thank you, Felicia, for that amazing introduction. Really appreciate it. Welcome, everyone. As Felicia said, my name is Keon Holmes. I work with Cambridge Associates. We are the advisor to Hampton on management of the university's endowment, including advice on investing in the venture capital asset class. I am pleased to be with you to help guide the conversation over the next 45 minutes or so, where we will discuss with this excellent industry-leading group of experts the venture capital landscape, what it is, how it works, and how students and the university can benefit from its growth. My co-moderator tonight is Jennifer Brown. Jennifer is a Hamptonian who now works with institutional investors across asset classes at Baring Asset Management. Jennifer is an excellent person. Let me turn it to you, Jennifer, to introduce our panelists.
Absolutely. Thanks, Keon, and thank you, Felicia. It feels so good to be back at my home by the sea. So I'm a Hampton University alum, class of 2006, and just so happy to be here, especially talking about the investment community and venture capital specifically. So we've got an hour to spend together, and we're going to take you through a really interesting journey across venture capital, really focusing on three things. So what is it? Who are the players? And how can we create even more exposure for Black venture investors? And so in order to do that, we were really thoughtful to get a terrific panel together that will share a number of different thoughts and ideas from three distinct perspectives, whether that's venture capital and growth equity funds and co-investments, direct investors themselves, and also one industry consortium leader. So someone who's really thinking day in and day out about talent and the industry that is VC today, as well as that of tomorrow. So Ed, why don't you kick us off with some introductions?
Well, thank you, Jennifer. I'm Ed Shirley, and I am also a Hampton graduate, class of 71. So this is actually my 50th year this year. I am a senior advisor at Fairview Capital Partners. We are a venture capital and venture capital and growth equity fund of funds. We've been in business since 1994. I've been at Fairview since 1998. And prior to that, I was in corporate finance at a number of small private equity investment advisors. And before then, I got my start, at least in corporate finance, at Equitable Capital Management, which was the investment arm of what was then Equitable Life Insurance Company. Matt?
Thanks, Ed. So my name is Mac Grayson. I'm a managing director at HarborVest Partners. We're a global investor in private markets where we've been active for over 35 years. We manage around $70 billion of assets across primary partnerships or committing to newly formed private equity funds, secondary investments, as well as direct co-investments. We're headquartered in Boston and have 10 offices around the globe. I've been with the firm since 2007, and I'm a member of our primary partnership or fund investment team, where I spend most of my time looking at opportunities and committing to venture capital and growth equity partnerships across sectors. I'm also very active in our ESG and diversity and inclusion initiatives. So I'll turn it over to Lo.
Thank you. I appreciate the opportunity to be here and share a little bit about my story. I graduated from Hampton in 1989, and I now am the founding managing partner of Plexo Capital. We are an institutional investor allocating across the startup ecosystem, primarily as a limited partner, into venture funds led by Black general partners, female general partners, and other people of color that are leading venture funds. And then we use that as a strategy to source opportunities to invest directly into companies from the portfolios of our GP network. The strategy was born inside of Google Ventures, now rebranded as GV, the early stage investing unit of Alphabet. We innovated the strategy as a way to be able to deploy more capital based on the insight that Black GPs in particular, where we started, had this unique network that provided access to differentiated deal flow, and then also a unique lens to be able to evaluate market opportunities that might go missed on other Sand Hill Road firms, and then also a different lens to evaluate entrepreneurs themselves. So I incubated the strategy inside of GV and then spun out a year and a half later in March of 2018. And I'm proud to say that aside from Alphabet, the Google holding company, Intel, Cisco, Royal Bank of Canada, the Ford Foundation, Hampton University is also one of our LPs and the one that puts the smile on my face when I share the story. Thanks for having me.
Is Nasir next? Is he our next? Yeah.
Yes,
Nasir?
Good afternoon, everyone. Nasir Khaizri here, also a Hamptonian, class of 2008. I believe I'm Onyx 7, founding managing partner of Zeo Capital Partners. We are a Washington, D.C. based early stage. We coin ourselves as an inclusive investment vehicle that's laser focused on backing exceptional, diverse management teams that's rethinking the building blocks of wealth, from education to employment pathways to financial inclusion. So a sector-specific fund laser focused on two sectors, the future of work and fintech, that we believe is vital to turbocharging economic mobility across the country. Prior to Zeo, I led AT&T's social investment fund Started my career in the public market, so a very unique pathway from the public markets to the private markets. Today's Zeal is about 44 million in AUM. Early backers are public today: PayPal, Bank of America, Synchrony Financial, to name a few corporates. And yeah, very much excited to be here and participating in this conversation. Thank you.
All right, our FAMU guy gets to go last, right?
Good afternoon or evening, everyone. My name is Malcolm Robinson. I'm a proud graduate of Florida A&M University. I think I'm on the wrong call, but I think I'll just keep going. No, love you guys at Hampton. I had been a professional investor for over 25 years. The last gig that I had was I started and ran the Asian funds for the Avenue Capital Group and grew it to about $5.5 billion. We were the largest fund in Asia, ex-Japan at the time, and invested in private equity, mezz, and distressed debt. I stopped doing that around 2011. And since then, I have split my time focused on being an active angel investor. I also am an LP in some of the more active Black GP VCs that started off around 3 or 4 years ago. And I'm also the executive director of the Black Venture Capital Consortium, which is my main focus at this point. I'll elaborate more in the discussion, but big picture is what we do is we try to take the top talent at HBCUs, including Hampton, where we're quite active, and inject them into either the VC community and or the startup community. And we have a number of programs to do that. Currently, we're at 6 HBCUs. By September, we'll be at 9 or 10. We have about 150 students involved right now, and we should be around 200 to 250 students in the September school year. Thank you for having me on the panel.
Malcolm, we're thrilled that we can be here, and thank you for all the work that you're doing across HBCUs and our community at large. So let's get started. I know it took us some time to go through those introductions, and we wanted to make sure we did this group of panelists some justice in terms of really illustrating for you the depth of experience and perspective that you're going to hear tonight. So as I said earlier, we've got really 3 topics. Venture capital, let's explore what is it. We're going to move into who are the players, and then finally, how can we create even more exposure for Black venture investors? And so, Ed, I remember when we started talking a few weeks ago, I love the way you described the venture capital industry and just the thoughtfulness behind how you would think about what is it, who are venture capitalists, what are the differences? So maybe opine for the group, and let's try to recreate the conversation that we had a couple weeks ago.
Well, thank you. Thanks so much, Jennifer. Well, venture capital, if you were to look it up at the definition, what it says is it is capital that has a high degree of risk invested in companies and businesses. In addition to that, though, I think venture capital has become investments in early stage companies that are generally technology based and that are, when they are successful, invested in disruptive technologies. Think about things that have absolutely changed the way we do things. So there would be, for example, companies that are that change the enterprise, change the way we do business. Think about things that a new way of receiving payments, for example. And then there are things that are consumer oriented. That's easy. Facebook, for example, Twitter. So these are companies that were early stage. Started out with an idea, and over time became technologies that then disrupted how we behave. Now, I look at venture capital in turn, I should say, I have Fairview we'll look at venture capital in basically two segments. There's information technology, IT as we call it, and then there's healthcare. Far and away, I would say that both of those areas are important, but information technology these days seems to have the biggest impact, at least on consumers and on businesses as we know them. Healthcare, though, is a continuing, consistent area of innovation. And I'll stop by saying, and go to Mac here, but essentially, venture capital is driven by innovation. Mac, what would you say about that?
I totally agree. So when you think about innovation, think about starting a company from scratch, and venture capital helps fund those companies, but also venture capital helps fund companies throughout each stage of development. So when I think of venture capitalists, I also think about what stage a company could be. So whether it's kind of initial ideation phase, kind of a seed stage, company is developing kind of a product, whether it's an early stage, company is starting to get that kind of product market fit, to growth or expansion stage, where the company is looking to kind of scale up, scale its customers, scale revenue, to later stage or pre-IPO financing. Those are just at a very high level some of the stages of company development, and there are specific investors that target each of those areas. So when I think of very early stage, seed stage, you may think of angel investors, that probably tend to be your friends and family, high net worth individuals, accelerators such as Y Combinator or Scouts that are funding some of these companies at inception. Then you start to move up, look at seed funds, which could be teams, or they could be single or sole GPs, maybe raising small funds from, a number of individuals or family offices, or maybe some institutional investors. And then really, when you start to raise, or investors start to raise larger pools of capital, $100 million and above, I think, you're really starting to rely on institutions like endowments, foundations, fund of funds, pension funds, et cetera, to, really fund ultimately those companies. One thing I did want to note here, I know we've thrown out some lingo here, GP and LP, which you may have heard so far in the conversation, but we think of investors in venture capital or private equity funds as LPs or limited partners, just in one vehicle that some of these partnerships are structured in, and managers of venture capital funds or private equity funds as GPs. So we did just want to make sure we level set with that definition.
And so Malcolm, from your perspective, I know you do quite a lot of work, as you said, across historically Black colleges and universities, working with students and professionals who are interested in breaking into the space, or perhaps are quite experienced. Tell us a bit more about engagement in the space from your perspective across current students, undergrads, as well as professional investors in the space.
Sure. So as everyone on this panel, and I'm sure in the audience is aware, the venture capital industry and the other side of the coin, the startup community, is one of the least diverse industries on the planet. So what we're really focused on with the Black Venture Capital Consortium is to create a pipeline to insert more Black individuals in both those sides. We started this several years ago, and it did take off significantly since last summer. We all know why, where we now are engaged with up to over 40 venture capital funds who either, almost all of those take some of our students as interns. They also are mentors. They help provide, become a guest lecturer for some of our curriculum that we do. So the engagement with the venture capital community has definitely gone up significantly since last summer. In addition, what we're finding is with the students that Hampton, Howard, FAM, all those, that they had a notion, a sense of what VC was, but they didn't really know what the opportunity set was, what type of compensation they can make, how there's sort of a pathway to naturally go out eventually and do your own fund, all that. So as we are at a campus for at least 1 year and we go to the second year, we definitely see a big pickup in interest, not just on the VC side, but also on the founder side or working at startups. So just getting the word out there and showing them a pathway of going to the next level has definitely been huge. And we believe, as I stated earlier, the goal is by the summer of 2023, that we will be at around 15 HBCUs and have 300 to 400 students in our collective programs. And at that point, I think we'll really start making a difference in terms of the pipeline and feeding into both those parts of the industry.
And I'd love to just, get in a serious take on bringing this back home to Hampton and, why should we care about this? Why is venture capital so important to us as Hamptonians, whether that be from an investment opportunity set, a career pathing, entrepreneurial opportunity set? How would you describe that in your words, Ms. Sear?
That's a great question, Jennifer. We all know the staggering data point around the just south of 70 trillion under management, only 1.3% looks like everyone in this room. And so if, it's important that we lean into models like Malcolm and others that have made significant leeway in terms of how we are rethinking how best to train the next generation of investors. So I'd say from a career perspective, when you and I, Jen, when we were in the School of Business, probably 3 buckets when we thought about financial services is what really came. It was investment banking, maybe sales and trading, where you and I both started. And then there's probably asset management. The private markets is still a fairly new asset class, even newer to Black people. And so I think it's important that we lean into models like Malcolm's and others to expose our Hamptonian students, and not just in the School of Business, all across, Felicia, different schools, because you can have diverse skill sets to be impactful and impactful in the venture capital private markets industry. So that's on a career pathway perspectives, ensuring that we're exposing Lo, Ed, Jen, myself, and others are marching down to Hampton because representation also matters as well. So we need more calls like this. Number 2, from a venture capital, venture capital perspective, from an LP perspective, I think there's still a great deal of the most storied active LPs in the private markets who don't have, and GPs themselves, being the Kleiner Perkins, the Sequoias, et cetera, don't have strong relationships with HBCU board of trustees and CIO. I think, Ed, you guys have done a great job in really molding those relationships.
Thank you.
So that HBCUs have access and deep relationships to the private markets. And so I would say, really, I think leaning in terms of exposing and deepening the relationships for the board of trustees across all HBCUs, the CIOs. Keon, I credit you for being the connective tissue to mostly all the HBCUs and ensuring they have access, deep relationships to high growth venture firms that can produce outside returns that will in turn yield an increased endowment for Hampton, Felicia.
That's terrific. And Lo, I know when we were talking a couple of weeks ago, you made some really good points around seizing the moment, and so for a number of us, we've been in the investments industry for quite some time. But if you're joining this conversation tonight and you're a scientist, technology innovator. You've got a great business idea. You're an emerging entrepreneur or an established entrepreneur that's maybe raised your seed round of funding. Tell us a little bit more about lessons learned and how we can make the most of this moment, because it is an opportune time.
That's a great point. And I think my perspective is probably fairly unique because I've worked at the large tech companies like eBay, Zynga, and as well as have been a startup CEO. So I was a hired CEO for a company that had venture funding from Khosla Ventures. Vinod Khosla was on the board, and then was able to transition into venture. I think it's really important for wealth creation in particular to really think about these opportunities that present themselves that I believe for the next decade, probably more, are really going to drive and become the basis for wealth generation. I mean, that's why we see so many people trying to get access to this asset class of venture capital, the ability to be able to not only benefit as an entrepreneur with an idea to be able to accelerate the growth, but also it's extremely attractive to the people that have made money in technology, outside of technology, a lot of these family offices, which are entities to be able to grow wealth that's been generated for generations to come, as well as the allocators that we have on the call. I mean, this is, an attractive asset class because we've just seen the ability to generate superior returns. When we look back at the data going back to 1983, in the venture class, investors in early stage, on average, on an annualized basis, have made 22%, which is amazing, and the median return is a lot lower at 5.6%. But there's this shape of that curve because of the distance between the median and the mean. It is called the power law because it changes it from a bell-shaped distribution curve to a slope. And the reason that slope exists is because of companies like Google, Facebook, Twitter, these companies where investors at the earliest stage and also the entrepreneurs and early employees that get to those companies, when they have those results that present themselves in a liquidity event through an initial public offering or a large acquisition, I mean, these are enormous gains that are made. And, I think we're seeing the beginning of another revolution. We had the industrial revolution, now we have the technology revolution. And so it's not just important for graduates at Hampton and other HBCUs to understand the importance of venture capital as a prospective entrepreneur or even someone in the industry. I think it's actually important to recognize that there's a certain skill set that's going to be necessary moving forward to be able to generate wealth. When I went to Hampton, I was working at eBay and people thought I was crazy. I remember in 2002, my fraternity brothers from Kappa Alpha Psi were calling into me saying, "Ooh, it's so risky." I was employee 2,848 at eBay. It had already gone public. And I think it's just this mindset that it was more of a traditional career opportunity to be able to go and be either a doctor or lawyer, or if one was going to go to a company, go to like a Goldman Sachs, Morgan Stanley, or a consulting firm. But now the skills that are necessary are those that allow someone to participate in the technology transformation that we're seeing across the board.
It's such a great point that you made, because I think that there's a level of tenacity involved in this. If you're an entrepreneur, an innovator, you've got a great business idea and you're looking to scale it in an institutional manner, and also serve your LPs as well, right? Because they are looking for an attractive return to meet their own investments objectives. But I think that sometimes the issue can become, access. How do you get backing? If you've got a company that's established, you've got a proven technology or a promising technology, how do you actually get backed? And I know this is a great question, I think, for Nasir and yourself, Lo, to opine on, because you and your teams are out there each and every day. You're looking for companies, attractive teams to invest in, and you're accountable to the LPs that have put their confidence and their assets in your funds. So give us a sense for, how do we seek backing if we're an innovator or an entrepreneur? And also, what are some of the issues that you've got to balance when you're thinking about investment selection and which teams to back?
Yeah, Ed alluded to the different types of funding vehicles given the stage. And for us, when we think about early stage investing, it's important as a venture capitalist that we have deep relationships, not only with our peers as we think about early stage venture capitalists around the country, but also ESOs, entrepreneur support organizations, or accelerator programs or incubators that actually house incubate these companies that are seeking capital. And so, for example, for us, we've partnered with 24 ESOs, entrepreneur support organizations, from New Orleans to Atlanta, here in Washington, D.C., in the middle of the country, and of course, coupling that with our relationships in New York and Silicon Valley, traditional tech hotbeds, where these entrepreneurs are building businesses. So it's important that and especially as we think about, Jennifer, increasing diversity, right? If entrepreneurs are truly going to be the change agents of our country, for the globe for that matter, then it has to include everyone, not just the very few coming from the same places, being graduates from the same school on average, 5, 10 Ivy League schools. Nothing wrong with those universities, but we have to cast a wider net. And so as we think about differentiated sourcing capabilities and leaning into quote unquote flyover city secondary markets, recognizing that great investable entrepreneurs are also in Atlanta, here in DC, and Des Moines, Iowa, and Kansas City, where we're sourcing great companies. And so as a venture capitalist, and it's important, and I'm sure Lo can attest, and even Ed, as a question that comes up often, like, how are you finding these entrepreneurs, right? How are you different from X? And so that's a key question I had to be very clear and concise on. And so it begins with our deep relationships, obviously with the track record. And most of the time, your track record, really shows that you've done this before. And you have the ability to, and you have a reputation also as it aligns with your strategy. And so the relationships, Jennifer, particularly at least for us, ensuring that we have access to these ESOs around the country is important as we think about providing access and resources to entrepreneurs.
I'll chime in a little bit. I think, and Nasir and the folks that are the next generation of general partners creating leading franchises, without a doubt, have a different perspective about how they're thinking about identifying opportunities. And for me, this goes back to the original strategy that we had at Google Ventures, this insight around Black GPs having a unique access to a network that really is a result of the fact that, as Nasir just pointed out, like, there's 2 dominant universities for most of the venture capital seats on Sand Hill Road in Silicon Valley, and that's Harvard and Stanford. Mm-hmm. And so what ends up happening, if you think about it, like, historically, that probably was a benefit when Silicon Valley first got started. If you go back to like the 70s, Hewlett Packard, like all those types of companies, Fairchild Computer, because it allowed the ability to move quickly, to be able to identify potential employees. That's great. However, we've changed as a world now. And so it's important to be able to realize the best returns for investors, to uncover opportunities that other people might not be going after, right? There's one thing to follow the pack, it's another thing to be able to identify opportunities that everyone isn't looking at. And I think because of the nature of this next generation of general partners leading venture funds and growing them into franchises, coupled with the demographic changes that we're seeing, there is a new generation of people that understand the importance of diversity as it relates to actually also being able to generate outsized returns. That was our thesis, right? So these Black GPs have access to different networks and they have a different lens to evaluate opportunities. That's really important at the seed stage in particular. The seed stage is kind of typically the first check an entrepreneur will take. At that point, there's usually not a lot of data, right? So since there's not a lot of data, what really counts is that investor's ability to kind of see the vision that the entrepreneur sees for the market opportunity. Typically, that's going to take some type of familiarity with that market. And when we look at a lot of the general partners that are building franchises today to invest into entrepreneurs that are addressing some of these demographic shifts, looking for entrepreneurs that see opportunities in other places, it's going to take a little bit of an understanding both of that market opportunity without any data, plus the ability to go beyond the typical prototype that Silicon Valley uses, which is the Harvard dropout in a hoodie, right? So I think it's really important to be able
Not
to
that I'm taking any offense to that.
Thank you, Lo, for bringing it. Bring it, Lo.
Mark Zuckerberg, mom.
I'm double HU. I left my hoodie in the other room. It's okay,
That's what
Lo.
happens.
Right.
That's what happens. So
Or
for
the
me,
MIT graduate, the same thing.
or the,
Uh-oh.
exactly.
So
for
Malcolm, you
us-
can now put your hat on. Go ahead and put your
There
hat
you go. So look, when we think about our model, we look at leverage, the ability to get capital into the hands of the Nasirs of the world. It's going, and the data tells us when there's a diverse set of investors around the table, their portfolios end up being diverse. So if we can get capital into the hands of diverse GPs, it will go to diverse entrepreneurs who we know have a harder time getting access, to your point, Jennifer. They can execute against their strategies, get to a liquidity event, build some wealth for themselves and their early employees. Then everyone has financial optionality because they have a backstop. Now they can incur more risk. Maybe some of the early employees can now start a company or invest in their colleague. Capital goes back to the GPs as a result of the exits. If the GPs string along enough exits, the GPs go down a wealth creation path. The GPs send capital back to the limited partners, the investors in venture funds, and they look at the limited partners, look at this and say, wow, this is really working. We should maybe double down or triple down. And so that's what I see as an opportunity. And it's not dissimilar to how a lot of these other geographic ecosystems have been developed. I look at Seattle as an example because San Francisco is so unique. Look at all the Microsoft and Amazon employees. Once they generated enough wealth from themselves, from the company, they had financial optionality. They could then go and incur more risk. And as a result, actually have the potential to make more money. They could become venture capitalists with their own money. They could invest in companies as angels. And what we see is the opportunity to do something similar, thinking about this vertically around both ethnicity as well as gender.
Yeah, and if I can just interrupt, I've got my business development director looking at me now, and so I'd be remiss if I did not mention the fact that there's something that Lo just said. Fairview, as I said, has been around since 1994. We had an annual meeting today, and we've invested over our lifetime $9.9 billion. We are segmented into venture capital, growth equity, co-investments. We do what we call next gen or emerging managers that would include the group that Lo just talked about. And, in looking at our history, I was actually surprised to see that we've invested in 66 emerging managers. I had no idea we'd invested that many, but we've done that. And when I look at, so now I think we are looked to by various institutions to continue to do that. And we do it with intentionality. The last thing I'll say is on that is this, our firm was founded by two Howard graduates, Larry Morse and Joanne Price. Larry is now the chairman of the board at Howard, but they are still founding partners and they're still there. I met Larry at Princeton in the 70s, and that's really how I got to Fairview. But our path is different, but we have managed to stay in business, to do well. We put our track record against anyone in the business, and still to keep a focus on emerging managers. And we are glad to see what's going on in this business now. To be able to sit here with Low Tony and everyone else here, to see Keon up at Cambridge Associates, you know, and Cambridge, you and I got to talk about getting Hampton as one of our LPs. But you know, that was not the case 20 years ago. So
Ed, you know what I like about what you said, Ed? I don't know about the Howard part. So, and that's a story for another day. My sister and I went to the real HU, Hampton, very proud of that. And when we get to the battle of the real HU, it gets real interesting because my brother is a Bison. So he's a graduate from Howard. We forgive him. But what I like about what you shared in particular, Ed, is this concept of it's so important to invest back in ourselves. You know, so we've been talking a lot about the investment opportunity set, the players, the talent, and the future that could be. And I'd love to hear more perspective on, you know, what can Hampton do? And what can leading colleges and universities across the country do to create more pathways for students and entrepreneurs who are interested in this space? But I also want to throw it back to all of us that are here in the room tonight and ask, you know, how does this connect to endowment giving? And Keon, I know you work with numerous endowments and foundations that each and every day, their boards, their trustees, you know, they're tasked with a very difficult job to do, which is serving the needs of their universities, different pools of capital, and managing investment objectives in a way that's responsible and looks forward to many generations to come. So I want to throw that question out to the group, which is, you know, number one, how can Hampton and organizations, colleges, universities like Hampton prepare our students, our community more for these opportunities? And flip it back, how does this connect to endowment giving?
Jennifer, I'll go ahead and start. One is having more of these conversations and mirroring these conversations across other HBCUs. Keon, Malcolm, I'm not sure if you're doing this with your program, but to the extent we have some form of curriculum within, not just during the summer for internships, but some form of curriculum programming while students are in school. So they have access to resources, learning about the private markets. One of the unifying themes I gather, led by Lo here, is wealth creation. The more Black, or just say more HBCU alum that are general partners, whether you're a limited partner or general partner, you have access to wealth creation, which means you have access, your ability to change the trajectory in your family, yourself personally, your family, which in turn, Felicia, will provide more liquidity for or dry capital for Hamptonians, HBCU graduates to give to HBCUs. And so, yeah, the private markets provides a great deal of opportunity for wealth creation. And I think we can all attest that this is a great career trajectory in efforts to do so.
And someone in the chat said this call is everything. And Lo, you started it with the hoodie. So we're going to pick it up there, because one of the things we talked about before this conversation was we know this is a heavy lift. A lot of folks don't understand it, right? But you all need to be part of it. And there's a way, there's a place for you, which is what Jennifer was talking about. And so Keon, because you work with Hampton, I want to make sure you have an opportunity to really lean in on that question about endowment giving and how this can connect, and quite frankly, other avenues.
Yeah, no, thank you. And by the way, a lot of the things that I've heard have been excellent and make a great point about venture capital as an asset class. Let me just start there, because venture capital as an asset class is a real driver of returns for any university endowment. It's becoming a bigger and bigger part of endowments, generally speaking. The more venture capital you had in your endowment in the fourth quarter of 2020, the better the performance was of your portfolio relative to peers. So it's a growing area. Everything that you've heard from Lo and Nasir about the wealth generating opportunities from it is true. The history of it, though, is that endowments have been underinvested outside of the Yales and the Harvards and Stanfords for years, because it takes support. It takes support to pragmatically do this. The institution has to be strong financially to take these types of risk in venture capital, because there is a risk that companies at the earliest stages may not succeed. But those that have the support from their alums, from a giving standpoint, and those institutions that are operationally sound are the ones that can take that risk. And unfortunately, that sort of wealth creates more wealth. But I think we're at a point where we are able to participate more and more. And you can hear from Lo and from Nasir and Ed and others that this is going to be able to generate tremendous returns for HBCU endowments longer term.
And we got to get in the game. And as the good book says, without knowledge, the people will perish. And that is what this is all about tonight, is to help elevate the conversation. And I put in the chat box that this was a thoughtful Tuesday. Today happens to be Tuesday, and we hope this is thoughtful, that we're intending to try to inspire, motivate, and educate. At 6:47, there are 7 questions. I think it's 6. One is a comment in the QA. And so Mac and Malcolm, because we haven't heard as much from you, we're going to start with you. And guys, we will be done at 7 p.m. So we're going to call this speed round. And so this question starts out like this: what headwinds exist for HBCUs as they seek VC funding? So Malcolm, start with you. And if you want to hand off, go for it.
As they seek VC funding, or as they invest in VC? I'm not sure I understand.
The word, Victoria Cotter asked this question, and this is, again, a way that we can help educate. And her question specifically is what headwinds exist. And so if you want to amplify and try to provide some context, that will be useful.
I'll quickly interpret what I think the question is. So I think in terms of the endowments, HBCU endowments investing in VC, one of the biggest headways, and I'm sure Keon can attest to this, is getting into some of the more established VC funds, right? Those are usually oversubscribed. They usually have a long history of relationships. So, but there's been a big shift in the last X number of years of some of the more up and coming funds actually outperforming. So to the extent that these endowments cannot get into those more storied VC funds, you have a number of individuals on the screen who are running their funds and or investing in other funds that have outperformed some of the ones in Silicon Valley. So I would say that that used to be a big issue, but I think with the proliferation of a lot of really good new funds, that should not be as much of an issue. I think more so, quite frankly, it's educating the alums, it's educating the investment committees of the endowments of a lot of HBCUs, so they understand fully what is going on in this dynamic market.
Do you think that's not happening today, Malcolm, this education that you just...
No, I think it is. I think it takes time, because I think, for instance, I've been a professional investor for over 30 years, right? And 20 to 25 of those, I really didn't focus on VC. But even with me, because I am an LP and I'm also an active angel, it took me a little time to reorientate my view on VC, because it is a very unique asset class. So if you have, let's face it, most HBCU endowments are relatively small. So then most of them are not going to have historical experience investing in either directly with startups or with venture capital funds. So it's going to take time for them to fully appreciate not just what VC funds can do for them, but also, I'd say just as importantly, I'm totally going to elaborate on what Lo was saying about the wealth. It's not so much a nice to have anymore. If you really step back and look at what's going on in the tech world, if you look at the last 20 years, the 2 biggest drivers of the wealth gap have been low interest rates and the disruption that's been going on in the tech world.
The drivers of the wealth gap. That's what you just said.
Drivers of the wealth gap in the last 20 years have not been jobs, have not been everything else everybody talks about. It's been low interest rates. So if you have assets that go up in value when interest rates go down. And the second thing, not necessarily in order, I'd actually say the VC revolution has been a bigger driver. If you look at the amount of wealth that's been created with such few people, we've never seen this ever in humankind. So, and it's just going to accelerate even more. I mean, everything Lo was saying, times 10 going forward. So to me, the reason why I'm doing what I'm doing, in terms
You
of
want to change that?
individuals, but it's just as important for the institutions. If we as HBCU students and alums and the endowments don't get in this, that gap is just going to get much greater. All the leading edge fields, industries are being transformed by technology right now. So
okay. So I hate to jump in, but we have 6 more questions, and I think we can save that conversation for another, because you put it in lay terms as why should this matter to me? I mean, you just broke it all the way down.
Right.
So
you have to get in the game. I think that's what Malcolm is saying.
yeah.
And the fact is that it just so happened, Hampton, here on this panel, you can get in the games in different ways. Lo Tony has a great fund that is focusing on emerging managers and funds as well as direct investments. Fairview, we've been around 26 years. We have, hard to access relationships. We also have emerging managers. Same thing with Mac. So right here, the issue is ask Keon, right? He's the consultant.
Yeah, you get to carry the weight here. Come on. Yeah. You got big shoulders.
Tell Keon what you want, and start the dialogue.
I think this is I agree with whoever said this panel is everything. Mac, Rod asks, I work in the K-12 space, and most companies we conduct business with are owned by private equity firms. Is that an exclusionary practice? Currently, it's a $14 billion industry and growing fast.
So I'll answer it this way. If you think back to venture, it's all about starting and funding innovative companies. And I think what we saw during 2020 was that COVID sort of accelerated digital transformation. So there are a number of companies that were started 5, 10, 15 years ago that I think really kind of accelerated, and perhaps that's what Rod is mentioning with some of the companies that he's seeing now. Because when you look at the trajectory of the life cycle of a company, you may start off as being venture backed and you're scaling and growing, and at some point, perhaps there's an ownership transition and a private equity firm comes in, and they're helping that company, helping grow that company to the next level. So so from our perspective, we don't see private equity as being exclusionary. It's a way that it's a form of funding that companies can take to help accelerate their growth.
Okay.
So so I think if
appreciate. All right, Jennifer, you got to do the heavy lifting, and didn't she do a remarkable job, y'all? Awesome. So anonymous attendee, and I fit into this. I just got my doctoral degree, not in business. I did get my MBA. But this question says, everybody has a business background. Do you feel that's necessary? Except Keon, he's an engineer. Is there another engineer on the panel? Is there somebody else that, Ed was in the military. So Jennifer, what do you think about who can get into this industry?
Anyone.
Great answer.
I think you need to have some ingenuity, a level of stick-to-itness and drive. I think if you have purpose, you can do anything you put your mind to. So certainly you don't need to have a business background. And I think that we made the case earlier as to why having a STEM background, maybe a consumer background can actually really be additive, whether you're on the investment side of the business, and a variety of roles within investments too. Remember, I'm in more of a relationship management, capital raising position, which can be quite interesting. We haven't really talked about that in terms of partnering up with, investments, staff LPs that are looking to really assess investment managers and opportunities. That's for another day. But I would say that in terms of an MBA, it can be useful for developing know-how around operating companies, developing strategy, implementation, execution, a variety of skill sets, and then also being able to take advantage of internships, externships locally here in the United States, but internationally as well, and the network that can come with that. So while I did leave the workforce for 2 years for a full-time MBA program and would do it again and again, that's not for everyone. And I would just say, you create the path, just stay true to yourself, your goals, your objectives, and look to give back along the way.
And we're way proud of you. This sister is representing everybody. We got the females in the house, okay? So Nasir, I want to ask you this question from Ron. And Lo, I think maybe recognizing we have 3 more minutes, can you offer advice to new founders of color who are not as connected to funding to assist them? Go. Nasir, you first, then Lo.
Yeah, I would say, there's so much resources out there that you can access, whether it be, leaning into these accelerator programs. So find out, different incubators, ESOs in your own backyard, lean in, become a mentor, advisor, get to know the ecosystem players. There's a way to be proactive. One of the things I share with my mentee, we connect every Monday morning, and I encourage him to either write Medium or a blog post, whether you're responding to an article or you're crafting your own views on an industry or an issue, and really putting yourself out there a bit more. And so I think there's more resources, free resources at that, versus 10 plus years ago, that is easier for aspiring investors or founders to be a bit more to show their their domain or operating or investment acumen.
Okay, Lo?
I would say, look, it's hard I don't care what color or gender one is, it's hard to raise money as an entrepreneur or as a general partner. It's like, I got 99 problems, so now I got 100. And the thing that I think is effective as an entrepreneur, ask entrepreneurs for introductions to investors.
Thank you. Network.
Introductions that I look at the most and the best typically come from the entrepreneurs, because they have a super high bar, because they don't want to send a bad deal to one of their investors. So they usually are a pretty good filter. They're able to give good feedback, and they're usually maybe just a few stages ahead. So it's good to develop a relationship for some peer mentoring anyway. And then I would also say, go and fish where the fish are. So figure out where investors hang out. A lot of them hang out on Twitter. Join the conversation, or as Nasir said, establish yourself as an entrepreneur that's a thought leader in a particular area to be able to get credibility when joining the conversation.
And I'm hopeful that you all join me in this quest to have more conversations like this. But unfortunately, I have to go against myself. We're gonna go over 7, but not much. This is really the speed round. I'm gonna ask for last comments from everyone. And we're starting with ladies first. Jennifer, I was going to say Jen. Jennifer, tell us your last closing comment. Craig is suggesting we ask you, what is the key to starting and sustaining a successful venture? But quite frankly, what I want to hear is, what's the most important thing you think you'd like to leave with those listening about this conversation today?
We need to lift as we climb and pay it forward. So as you stay focused, work hard, and work with purpose, think about how you can bring others along.
Awesome. Mac?
Yeah, I think it's just taking advantage of the opportunity. Yeah, I think there's a lot of tailwinds to get into the space, access capital, get closer to venture firms, start your own firms, and a lot of initiatives out there. So I think if you're interested, now is the perfect time to get in.
All right, Malcolm?
One of the things we didn't touch on would be active angel investing. I'm sure a bunch of the audience are thinking about that. There's a number of active angel networks. The key there is diversification, and also just seeing a whole bunch of different companies so you have a better sense of what is actually good and what is bad. If you don't have the time, you don't have the inclination, you don't have enough money for diversification, and you definitely should be talking to one of these other individuals on this call.
On this panel, that's right. All right, Keon.
I would just add just the supporting of each other. Obviously, Hampton's doing some great work to educate, with Malcolm's help, future founders and also creating future venture capitalists and funders of venture capitalists. And so just being supportive of that process, because it should be self-sustaining if it's done right long term.
Awesome.
For Hampton.
Oh, I'm sorry, Keon.
No, I was just saying for self-sustaining for the broader ecosystem, the university as well as the graduates.
Awesome. Lo?
I think the takeaway here is get in the game. The world is changing, and we need to be able to access both at the university level for the endowment and grow our endowment to rival those, you know, the Yales of the world. They could never raise another dollar, and that institution will exist into perpetuity,
Right.
or until the end of time.
Yep.
Yep. Nasir?
+1, everyone. The truth is, if you want to go fast, go alone. If you want to go far, go together. I agree with Keon. We have to work collaboratively, can't work in silos. And yeah, that wealth creation is key.
Thank you for not charging Hampton tonight for this, these pearls of wisdom. Ed, you get the final say.
Great, thank you. It's a marathon and not a sprint. And if you get a no, whether you're raising a fund or raising money for a company, take no as advice and then ask why and go back.
All right, is everybody saying bye? Is that what's happening? So the thing I will say to you all and those in the audience, remember your HBCU. Remember your HBCU in your endowment giving. Please recognize how difficult it is for students to get the quality education you all had. I don't think it's fully understood the barriers that our young people are facing today in a worldwide pandemic, and then with other issues that are going on in the social space. So that's the one thing that I would say. I think, Jennifer, you said it, lift and bring somebody along. And when you do that, you'll see you can change the world. Malcolm, I love what you're doing with the students. I'd love more thoughts about another Thoughtful Tuesday session. One of the things that Keon and Jennifer said they would be, and I hope they aren't taking it back now, is committing to a series of conversations like this, because I'll just say it, we don't talk like this. We don't have conversations like this as often as we should. So I hope you all, if you're interested, email me, and thank you all for joining tonight. Good night.